This is a little bit creative. I hate to use that term. We're not supposed to use that because in 2008, they used a lot of creative real estate, which was just fraud, okay? And they called it creative real estate. But this is a little bit maybe alternative financing, non-institutional financing, non-bank financing that you can use. I've talked to a few of you out in the audience beforehand, and this topic is going to be very relative for what the kind of work that y'all are doing. Like I say, it's alternative financing, you know, not traditional. I'm not traditional. And the way I work is, I like for y'all to applaud first, and then I'll give the presentation. Yeah. So can we get a round of applause? I'm glad you did that because my presentation matches the applause. So, you know, y'all got it a little better at the end. So this will be a good one. Take notes, if you will, and there'll be a lot of demonstrations to help you remember, but you still need to take notes, okay? What this really is, sell the house and keep the mortgage, it's just a tool you can use. I was watching CNBC, the financial news channel, and Kelly Evans' show was on. She said, wouldn't it be nice if you could just buy a new house and just move your mortgage with you? And of course you can't if you have a Fannie Mae loan. But we're going to show you a way here today that you can actually do that over and over and over again. And you can reduce your closing costs tremendously by doing it. That's just one way you can use this. It's a tool, okay? You can go to Home Depot and you can buy you an East Wing hammer. That doesn't make you a carpenter, okay? So I'm going to show you how to use the tool, a couple of examples, and then you need to work with it, and you'll get better and better as you go with it. Let me just, for our first little demonstration here, let's pull out a tool that a lot of y'all are familiar with called a sledgehammer. Now the sledgehammer works really good if you're swinging it to bust up concrete. It is really good. And when you're young, like you're 18, 20-year-old male, it's a lot of fun. Swing this hammer, hit that concrete, and it goes everywhere, okay? I kind of relate to sledgehammer. It's kind of like flipping houses. You can do a lot of good with it, but it's hard work. I mean, it's hard. And if you're doing that and you're making money at it, for God's sake, keep doing it. But I'm going to show you a tool that you can kind of move over with your financing and maybe not flip all those houses, but maybe keep a few. Which, if you talk to any of the folks that have a lot of money in real estate, they made most of it by buying it and holding it over an extended period of time. That's how they did that. So we're through with the sledgehammer. Really good on concrete. They sell these at all kind of building supply places. And if you want to try it and go bust some concrete at your house and watch everything go like that, let me warn you, it will send showers of concrete about the speed of light. And some of them will find their way to your eye. And it doesn't feel good. And you're not going to look very macho when you're going, ugh. So if you try it at home, get you some eyewear to go with it, okay? That's just a little safety tool. Now, as good as that is for busting concrete, it's not real good at chopping down a tree. I think you could. You bust those molecules, but it'd be a long time. An axe is a much better tool for chopping down a tree. So this tool may not solve all your problems, but it's just one tool. And if you're planting a tree, that axe would be kind of hard, but this shovel will work pretty good. And I purposely picked this one because it's short and it fit on the table. But, and I mentioned hammers. We got roofing hammers here. You don't have to be a real good carpenter to use these. You kind of tap that nail and it kind of goes on in there. So the right tool can really save you a lot of money. And Brett up here looking for some free labor. Y'all know Brett back there? Brett brought this to me, little bolt cutters, which works real good for cutting bolts. Not good for cutting down pine trees. But he brought this to me and told me to bring it back to Hattiesburg with me. But anyway, so it's just a tool, okay? Y'all excuse me, my mouth is dry. I rehearsed a lot. Let's move on. Okay, we're talking about selling a house and keeping the mortgage. You may have heard them say walking the mortgage. You may have heard substitution of collateral. In this presentation, note, mortgage, deed of trust, they all kind of get intertwined together. I know Louisiana is a mortgage state. It's the extent of my understanding of the law of Louisiana. Mississippi is a deed of trust state. And that's about all I know about the law of Mississippi, at least all I'm willing to say. I really shouldn't say that much. But I'm not here to give legal advice, and I was really excited that we have John in the room. So when there's legal questions, which there will be, we're going to let him answer. And also we got Bob that's going to answer accounting questions. I am not an accountant. I'm not a financial advisor. I'm just an old man trying to share some of the knowledge I gained. This is kind of an educational thing for you to use as you can. All right, let's get started. Okay, what is walking the mortgage? This is how it works. You own this house free and clear, the one over here. And then you have this house that has a little equity in it, and it has a mortgage. And you just walk the mortgage from here over to here. You modify the mortgage, leave the notes the same. A real estate attorney will do the paperwork for you. Do not try this at your kitchen, okay? Get an attorney to do it. And the way John just explained it to me a while ago, it was really, really simple to do it in the state of Louisiana. So you have the mortgage here. We're going to change the mortgage secured about this house. We're going to change the mortgage and put it over here on this house. Free and clear works really good. It doesn't have to be free and clear, but it makes a good example and it's an easier sell. So John, if you'll come up here for just a minute and explain how they do this in Louisiana, the legalities of it. Keep it kind of on a 6th grade level if you can.
Well, that's I didn't get beyond that, so I think we'll be okay. And this is barring any, depending on your lender, and we're talking about non.
Okay, yeah, thank you. These loans work best if it is an owner carryback financing. Okay, if you got
type of private financing.
Yeah, if you have a Fannie Mae mortgage, this is not going to work. That's why Kelly Evans couldn't figure it out, okay? Because it won't work. Now, I have had bankers tell me, we're talking about community banks that hold their own paper, that they would be willing to walk a mortgage for a good customer. So you pay them on time, you know, you leave money with them. They'll do things they won't do for everybody else, okay? But yeah, it won't work on a Fannie Mae mortgage. It has to be like an owner
Which
that
to the
holds
point,
paper.
though, of that community bank, I mean, swaps, which we'll see a little bit more of too. I mean, and that's they'll do that in some instances. So I didn't even think about that correlation. Quick, easy. All right, you've got your mortgage and your note. Right, the note is secured by an act of that mortgage. That's a security instrument filed in the records. It creates security interest in favor of the creditor against that piece of property. So if you're going to do this, you're just going to do a loan modification to effectively substitute the collateral. Right, and partially release this property from the mortgage. They've got new collateral here.
Release this one.
Yeah, and it's
New
just
collateral.
you know, with a deposit and referencing to the original mortgage, so anyone who comes behind to look can connect the dots. But yeah, it's just a matter of modification to your mortgage.
All right.
There you go.
How long would it take you to do that?
Give us
The
some
actual work,
description.
not on the calendar. If someone just calls you up in the morning,
Calls me up in the morning. Oh yeah, just like if you.
once you start typing.
Hour and a half, depending
Okay.
on how difficult it is to find the property.
All
Right.
right.
Yeah.
So it depends on how long the line is in front of you.
Yeah.
When you get to the front,
Yeah.
it'll be done like
That's
that.
the most difficult part.
Okay.
Some of this is construed
How
as
much
legal
equity
advice.
do you have to cash? Is this like a cash out equity? Like, do you have to have X amount of,
Okay, that's a good question. That's a great question. You have to have enough equity in this property that the person that holds this mortgage is going to be comfortable substituting this collateral for this collateral.
Right.
Okay?
The lender has to sign the change of collateral.
Yeah, the lender's going to have to sign it. This isn't something you can just shove down their throat. Okay?
It's not a notarial act of correction.
So,
How much, you own the property free and clear, you're substituting it for a different mortgage. I see the exchange here, but like.
okay, let's throw some real numbers here.
Yeah.
Okay?
Let's do that, please.
I'm going to use 100,000 because I know it's outdated, but that's the numbers I learned on, and it's easy to do percentages on 100,000. Okay, so let's say this one's let's say that this house is worth $100,000 here. Okay, we got 25,000 in equity. We have a $100,000 mortgage, and this one over here is easily, without any funny stuff. Anybody can figure out this is worth $150,000 on a really bad day and maybe $175,000 on a good day. That's an easy sell. Okay, the note holder will say, you want me to, are you sure? The next question is this legal? You know, I don't know, but the title companies do it, and that's what they do is legal stuff. So we'll let them figure that out. And if they, like, well, one of the best things to do, not trying to cost you in business here, but you say, okay, who did we get to do the title work last time? They'll say, well, we'll just get them to do it, okay? That way they can do it. Now, if you have a good relationship with a particular title company, which I do in my market, I would say, and you can use this using John's name, you say, Jim Thomas is a great attorney. His father taught me legal law in college. And he was a title attorney, second generation, does great work. We'll get him to figure out all that legal stuff, because quite frankly, I didn't go to law school. I didn't want to go to law school. I didn't want to do all the reading at the time. 2 out of 3 didn't make it through, so I didn't go. But he did, and he can figure this out. And you kind of put the legal stuff over on the attorney. Now, the advantage to that is you're not making yourself look stupid. You're making yourself look credible, okay? I'm not a brain surgeon either, okay? If my wife needs brain surgery, I'm getting a brain surgeon doctor to take care of that. It actually gives you credibility when you say, we'll let the professionals handle what the professionals do. You look confused. What do you not understand?
I'm good.
You're good?
Yeah.
Are you okay now?
No, there has to be a percentage of the equity paid down to even do this. That's what I'm looking for.
Well, they're not gonna take, so the lender is not gonna be at a 50% loan to value on this house.
Right.
And go over here to get 85% loan to value. So they're gonna probably walk it laterally, meaning if they're at 50% loan to value on this one, they're gonna want to at least be at 50% loan to value on this one.
Yeah, so let's look at the real numbers in this one. We had $75,000 worth of equity here. We got $75,000 worth of mortgage with 25% equity, so that's 75% loan to value. And this one has $150,000 equity, so when you move this $75,000 mortgage over here, you're at a 50% loan to value.
They're gonna sign that a lot quicker.
Yeah.
That's an easy sell.
Yeah.
Now, when you tell them this one's worth 85, they don't know. However, had you been paying this mortgage for 5 years, never missed a payment, and you tell them, well, I'd really like for you to move it over to this one. It's $85,000. It's not worth as much, but you know I pay you on time already, always have. They're more apt to do it. There has to be a certain amount of trust between the lender and you. You still look confused.
So what kind of loan you cannot do this, and what kind of loan you can do this?
A Fannie Mae mortgage that they sell in the secondary market, you can't do this. I mean, theoretically you could, But it's kind of like those outlying statistics, you know, the 8 standard deviation way out there, you know, on the bell curve that, you know, it's like a 90-year-old woman getting pregnant, and it just ain't gonna.
Portfolio loan you may can do.
Do what?
Like a portfolio loan, like the bank keeps the loan in their bank, maybe.
They could do it if they want to. The key thing is they got to want to. So that's how it works. Any questions so far? You have a question?
Could you explain Fannie Mae?
Okay.
Like just a little.
All right, here's the way it works.
Like a little bit.
Yeah, I'll do it really quick. You go down to your mortgage broker, okay? This is a nice desk, nice office, everything looks good. He looks down his long nose at you and he does the application, looks at your credit score, and he acts like he's got a bunch of money here. He's trying to decide whether he wants to lend his money or not. Any mortgage brokers in here? Oh, good. But actually what's happening is he wants to make sure that you fit the criteria to Fannie Mae, which is a secondary market, okay? It's a government-backed loan. So he's going to approve your loan. It'll be funded by a bank or an investor of some type. They are going to give you the loan. You get your money. You pay them their points. That's how they feed their families. Their families have to be fed, otherwise they can't come to the office. That's just the way it works. And you know, the title guy's going to get his part out of it, and the appraiser's going to get his. Everybody's going to be paid, okay? And that's only fair. But then once that's done, he is not keeping that mortgage in his desk and collecting those payments. He is going to sell it to somebody that's going to bundle it, get a big bundle and sell a big bundle to Fannie Mae, or he may sell it directly, okay? I'm not real sure how that process works. But basically what happens when it gets to Fannie Mae or somewhere in this chain here, they're going to have a bunch of these mortgages bundled up, and they are going to produce some bonds that are secured against those mortgages. You heard the term on the TV, mortgage-backed securities? That's what it is. It's a whole group of these Fannie Mae loans, and they bundle them together, and they tell you it's AAA, by God, and you know, yeah, and then they're gonna sell it off to investors all over the world, okay? And the reason they did that was back in the good old days when I was young, the savings and loans would lend the money that they had borrowed from depositors for like up to a maximum of 5 years on a CD. But they were making 20-year loans. And that was fine. They were really smart. They wore nice suits, you know, PTA presidents, the whole work. But it worked great because they were borrowing the money from Joe and Sue, homeowner, or working class people, and they're paying them maybe 5 to 8%, 6%, whatever. But then a strange thing happened. They had this thing called inflation. And all of a sudden, their rates went up to 8%. Now, you don't have to be a mathematician. If you're out here collecting money that you're getting at 8%, and now you're paying 12% on that same money, you're going to start to lose money fast. If you go into your history books, you can read about the savings and loan crisis, because they just started shutting them left and right. They were almost like banks, except they would mostly lend on houses. And you know the saying from The Big Short, everybody pays their mortgage. Yeah. But they went under, and because of that, they came with the mortgage-backed securities. They could sell it to these institutions that needed a steady cash flow for 30 years. They were happy to do that. That satisfied their funding requirements, and that gave them money to fuel the real estate market. Does that help you?
Oh, yes.
Good. Confused me, but I'm glad you're happy. All right, anything else? Can we move on? All right. So now you got it. Aren't you? These are my cards. This is what I do to tell me. It says, "Aren't you glad you came?" We're gonna move on here. This is how you make it work. Hey, before we move on, just leave it there. That's fine. But before I move on, let me ask y'all, what was your motives for coming here tonight?
Learn something new.
Learn something new. Let me ask you something, and y'all be honest. It's okay to be honest. How many of y'all came here because you want to make it just enough money so you can upgrade your car a little bit? If you did, raise your hand. That's all you want to do. You just want to upgrade the car and you're happy.
I'll do more, but it'll make me a little happy.
So when you upgrade the car, you're done. You're out of the real estate business.
Oh, no.
No? Okay. How many of you came here because you saw an ad on the TV about saving the wells and said, you know, I need to make some money so I can help save the wells? Anybody? Feed the children, which is a very noble cause. I have a good friend that, you know, he adopted a little girl, not physically, but financially. He got a picture of her. It's a good cause. But I don't think y'all are here for this. I know exactly why you're here. And you're too embarrassed to say it. But every one of you are here because you want to become filthy, stinking rich. That's why you're here. Now, you're smart if you realize you're not going to do that overnight. But I just like to tell the truth, so we play this little game. I'm going to point at this side of the room, and y'all say filthy. I'm going to point at this side of the room, and y'all say stinking. And I'm going to point with both hands, and y'all going to say rich. Let's try that one time. You ready?
Filthy, stinking, rich.
That's good. Y'all get better before it's over. That's a good start. Okay. So we're here to get filthy, stinking rich. We're already feeling better. Okay, we're good. We're good. No more notes for a while. So here's your situation. You have a house here that's $150,000 of equity in it. You don't owe anything on it. You've managed to get another $10,000 together. And you have kind of some dreams. You want to make this real estate thing work. The problem is, every banker I've ever talked to, they don't really take dreams as collateral, you know? They don't really lend a lot of money on that. Now, they will lend money on track records, but dreams, not so much. But how many of y'all ever read the book Think and Grow Rich? A lot of you. Isn't there a quote in that book, something like, everything existed in the mind first before it actually existed? So that is value in what you think, but it's hard to get it out of the banks. So, but you do have a good plan. So we got 150 here, 10 here, together you're up to 160, okay? All right, let's move on. So this 150, you're gonna keep it. There ain't no way you're selling it. It's in a great neighborhood. And if you need to put 2x that, 3x that, 10x that, whatever for your market, don't get too hung up on the numbers. So you got this keeper you're gonna keep. You got your $10,000 here, and you see this other house. Now this house, okay, the difference between houses and people is you can use houses. It's perfectly fine. You know, you can use them and abuse them. So this house is just a means to an end, all right? We're not in love with it. We got how many flippers we have in here? All right, I want y'all to finish this saying, if you know it, and I'm sure most of you do, for the sake of the non-flippers in here. There's an old saying, it said, when I do this, that's your time to go. Don't fall in love with your flips because they're not going to fall in love with you. All right? They don't know who you are, and they don't care that you went cost overruns, that you opened up the wall and there's a bunch of termites. They don't care. All right? It's a one-sided love affair when you fall in love with a flip. And you spend extra money on carpet that is way above what's in that neighborhood, you're not getting your money back, okay? All right, so this house is just a means to an end. And the means to the end is financing. We looked at the house, and we really don't like the house that much. It's okay. It's worth $110,000. But we couldn't get them down on a price, but we could get some real good financing on it. So we say, you know, I'd like to have that financing. So let's see what we do. We take our $10,000 and we make a down payment. And we may have to do some little rehab and all that. We get a loan for that somewhere else. We're gonna pay sales commission when we sell it, but that comes out of the house. And we put the $10,000 down and we walk the mortgage over to our free and clear house. All right, next slide. Okay. Now, I'm not an attorney. This isn't legal advice. However, for me and a lot of you, it makes a lot of sense. If you can follow the documents, you can figure out what's going on, okay? If I do say something wrong, you stand up and yell loud. Okay. There's going to be a warranty deed. Y'all use warranty deeds in Louisiana? Okay. We got a warranty deed or some type of deed that comes from the seller over to you. There's going to be a note you're going to sign to the seller for $10,000, remember? And we're going to have a mortgage. The mortgage is going to the seller, but the mortgage is tied to the note. And what this is layman terms. The note is a promise to pay. The mortgage is a promise you're going to lose your house if you don't. Okay? So then the mortgage, or if you cross the river over there and go to Mississippi, the deed of trust is going to be secured against this house, not this house. So it's real important that you remember that the mortgage goes against this house. Because if you mess up and put it over here, it's not going to work. And when we get to the end, you're going to say, how can you do that? You have a mortgage on it. So it's real important. Like I said, you got to move that over here. My good friend Leon Johnson did a presentation very similar to this. His artwork wasn't as good. He wrote it up there. But he did in Jackson, Mississippi, and it was about this long, and the chairs were like jammed up like this. And the aisle was just like that, so thin, two fat people couldn't pass. It was jam-packed. And then there was a room in the back, it was about 2/3 full. And the question that tripped up everybody was they did not understand this concept that the deed of trust went over here. And it was deed of trust because we're in Mississippi. In Louisiana, it's mortgage. Now, when you go home and explain this to your friends, the one thing that you've got to just pound in your head is that the mortgage is secured against this property. All right? Does anybody not understand that the mortgage is secured against this property? Okay. Let me ask you something. When we have a big room, there's always somebody in your call. But we got kind of a small group. Are there any educators in the room? Teachers? You're a teacher? You're a teacher. Excellent. Let me ask you something. I've been told by educators and psychologists that people learn through repetition. Would y'all agree with that? Sometimes. Okay. Well, that's exactly why I repeated it so much. I knew you were smart enough to figure it out. I just wanted you to remember it, okay? I'm not insulting your intelligence. Just want you to remember it. So there we go. All right. And the $10,000 you used to have, it's his now. All right, so let's go to the next page, and when we do, we're going to see what it looks like. Everything's said and done. The seller of the house now has your note for $100,000 secured by a mortgage on that property, and he has your $10,000. $10K, $100,000 note, $110,000 value of the property. He's feeling happy because he wanted to get rid of that thing really bad. You, on the other hand, you still have your keeper house, although you do have debt here of $100,000. And you also have this other house for $110,000 that's free and clear now. You don't want to keep it, but you got it. So you got 50 equity, 110 equity, 160. Do you notice? You don't have to be an accountant like Bob, but you can figure out quickly the equity hasn't changed, right? We're all the same. Now, if I was selling tapes for 3 easy prices at $39.95, we could adjust those numbers where, you know, the equity went up way good because you're real smart and you stole this house. But that's not necessary to understand this concept. So equity remains the same. Let's move to the next slide. All right, imagine a world, if you will, and where there's big neon signs floating in the air. This is going to hurt your business. And it's floating in the air, and it's pointed down at the property, and it says who owns the title to this property. And you drive by this property, the means to the end, with the wife, and she looks out there and she says, honey, I don't see our name on the title anymore. it's gone. And you smile and say, that's right, sweetheart, it's gone. Next slide. What has replaced it is a bag full of money for $110,000. So now we have our $50,000 equity, our $110,000 house, same equity. But what have you done? You've taken a house that you really didn't like, but you love the mortgage, and you kept the mortgage, and you got rid of the house. And you wind up with $110,000 cash. Now, I didn't go to graduate school. I didn't go to doctorate school. As I said, I didn't go to law school. But I did go to YouTube. And YouTube told me you got to know your audience when you give a presentation. Well, this audience knows what to do with $110,000. I don't have to explain that to you. You know, you do whatever it is you do. If you're flipping, if you're buying and holding, whatever, you can do this. And you say, Elbert, for God's sake, why don't I just go to the bank and borrow the dadgum money? It's been working for years. Well, first of all, you're not going to get the same good terms you have here. And number two, how many of y'all were in the business in 2008? All right. They had a little thing back then that, you know, they're having a lot of foreclosures, and the banks say, you know, we ain't really happy about all these loans we've been making. I mean, why would they? They're making them for 120% with no docs. You know, what could go wrong? But anyway, they got all these houses. Their solution was, instead of tightening the credit requirements and the financial requirements, we're going to limit how much you can have. So they let you get 10 loans. And then they said, that's too much, 4. And then they said, you can have your house and 1 more. I actually talked to a bank that told me we have absolutely no appetite for rental properties. Get this. They'll let you own your house, and they'll let you own a second house, and they're happy to finance it. One that doesn't have a tenant paying rent. I mean, they're happy for that. And they'll do it in the same town. You can have the house you live in and work in, and you can have this, quote, second home in the same town. I mean, that just tells you how ridiculous they get. But when you get in that kind of situation, you can't run to the bank and get the money. So this is a good tool to have, kind of like the sledgehammer. It's a good one, or the axe, but it has a certain place that you can use this tool. I think, does anybody have any questions so far? Okay, this is the part where I tell the mama story. Yes?
I have one question. So when I work alone, do I need to reappraisal for the new building with the keeper? And for the closing fee, how much that I can save in general?
That's a real good question. And the answer is depends, okay? Here's the deal. Can we back it up a little bit? Just keep going. Okay, go down. No, back it on up. Keep going. One more. One more. Okay. You said an appraisal. Do you need an appraisal on this property to get the loan? You have to, law school term, you have to have a meeting of the minds, okay? These people have to believe that this house is worth more than their house, okay? Have to believe it. What does it take to believe it? Will they only believe it if you have an MAI appraiser on this house? I mean, if that's the only way they'll do it, but they're willing to sign a contract, they'll do it. If it appraises out for 150, then there you go. If they're working with a realtor that can show them all kind of comps, then, and they look at that and it's clearly, they say, hey, it's worth 150, mine's only worth 110, you know, I need to sell it. If I don't have $7,000, I'm losing my duplex over here. They're jumping on it, okay? So the answer is, it depends on the guy that's financing it. If he requires an appraisal, then an appraisal is required. If it's not required, it's not required. Now, don't do funny stuff with them. Don't go up to them offering one that's worth $85,000 and get mad at them because they don't take it, you know. But you got to have legitimate equity. They need to be able to see it, okay? Now, you tell me you got a house in Arizona, I'm not going to do it because I don't want to go to Arizona and foreclose on a house, okay? But does that answer your question?
Yes.
All right, keep going to 1.9. Whoa, back, okay, right here. All right, this is a little story real quick. I'm gonna make it quick because we got kind of carried away here. If you ever come to my home and my two sons are there and my daughter's there and their spouses are there, well, my wife is very controlling. She's like, you sit here, you sit here, you sit there. You know, yeah. It can go on for a while, but eventually someone, and usually it's my daughter. Would y'all say at 29 years old you're an adult? Sure. Okay. I know she's an adult. Reason I know is for the last 7 years, she's told me on her birthday she's 29 years old. So obviously she's an adult. She will say to her mother, say, Mom, I'm an adult. I can do this. At which time my wife will say, well, I'm your mother, and that's what mothers do. Okay? So I'm not your mother, but I'm going to put on my cap here. It says Mama. Okay? This is my mama's cap right here. And when this is on, I need for y'all to take out your notes and write this down because this is very important, what's coming up next. Go ahead. Let's move it one more time. The must-haves for seller finance and notes. Oh, I had a heart attack. You've got to have either a below market price on the house you're acquiring, or you've got to have below market rates on the mortgage that you're keeping. Okay. Otherwise, you're just spinning your wheels. All right. It needs to be a fixed rate loan. You don't want to be hung out to dry on an adjustable rate mortgage. Well, in my opinion, you don't want to be hung out on an adjustable rate mortgage that can go up and you can't raise your rents that fast as the lender can raise the payments. You do not want to have a due on sale clause. Now, I'm not an attorney, but basically my understanding is that clause basically means when you sell the property, every Fannie Mae loan has a due on sale clause in it. And tell me if I'm wrong here, John, but if you sell a house with a due on sale clause, they may is the key word, may call the note due. All right? So you don't want that when you're selling. All right? We'll come back to this. You also want a first right of refusal on that note. Basically, what that means is that if they sell the note to an investor at a discount less than a face value, they have to give you the right to pay for that note at that same price. Now, wouldn't you be mad if you owed them $100,000 and they took $70,000 from J.B. Whitmore for the loan? Wouldn't you rather pay that $70,000 yourself? Sure you would, okay? So you want to do that. Now, some people do some creative things. They say, you got to have 90 days to do that. Well, no note buyer wants to put a price out there and not buy it for 90 days. So you're right, you're lowering the value of that note. But you're making sure you get the first right of refusal on that. And, now this is key. There's a difference between legality and reality, okay? You want the right to substitute collateral in this deed of trust. In other words, you want to say right in the deed of trust that we have the right to substitute another piece of property for this property. It kind of, the generally thing to do is to say that, you know, it must be approved by the person owning the mortgage. The people that do this day in and day out, I've never heard them forcing someone to take another piece of property. But if you really want to be legalistic, I guess you can get where there's certain terms. You know, if the property appraises for this, we'll do it, whatever. But then you got a trust issue when you're trying to sell it on the front end, okay? So basically, you have the right to substitute it. They have the right to approve the collateral, okay? It's not a perfect world. They may balk on it when it comes time to do it, but you want to have it in there. Let's go back to no deal on sale clause. The cool thing about a note with a no deal on sale clause is you can sell that property with, we can take this off here, we're just talking. You can sell that property with a wraparound mortgage, okay? How many of y'all know what a wraparound mortgage is? About half the room. All right, there's a little audience participation. Everybody stand up for just a minute. All right, those of you who have actually sold a piece of property on a wraparound mortgage, sit down if you've actually done it. Brett's sitting down. Well, the rest of you have not lived yet. Because it is the most profitable thing you can do. The rate of returns can be astronomical if it's the right deal. I know Courtney knows how to do that. Has she ever talked about that here in the archives? Probably. Okay, and I think Leon's probably talked about them. I know he's talked about owner financing before, but they are a wonderful thing, and they're very profitable, and you need to learn how to do those. A little hint for you on what to do in the future. Y'all can sit down now, but I'm telling you, wraparound mortgages is very, very, very profitable. Okay, so I think this would be a good time. If you ever start doing wraparound mortgages, you're going to learn how to become filthy, stinking rich, okay, if you do enough of them. It's like everything else. So we're going to do it one more time. Y'all ready? Let's try it. This time try to be a little louder. You ready? But except this time, when I point over here, we're all going to say filthy. When I point over here, we're all going to say stinking. I go over here, we're all going to say rich, okay? If you learn to walk the mortgage and you use it appropriately, there's a good chance it can be one of the tools that's going to propel you to become
Filthy, stinking, rich.
All right, y'all got to get a little better, but that's good, that's good. All right. The next section is real fast. There's only 3 slides to it, and this is like really getting into the weeds right here. But y'all are a sharp group. We have an attorney with and an accountant, so we're going to be okay. Back it up one slide real quick before I move on. Okay. Bob, can you come over here for a minute? Bob's my tax guy. When I went to school to get my degree in real estate and insurance, they told us all the tax law like it was fact. And then they said, you can never, ever tell this to a client. And I'm thinking, well, why in the world am I paying you to learn it if I can't tell it to my clients? Now that I'm 65 years old and the tax law has been changed over and over and over again, I understand that real well. You need someone that keeps up with the changes on a daily basis as a professional in that field. So Bob, CPA, years and years of experience. On our $110,000 we got here, you know, getting our $10,000 back and walking that $100,000 mortgage over there, for the record, what is the tax rate on that money?
Well, the tax rate depends on your current tax rate, but the actual tax you pay on this would be 0.
There you go. There you go. You don't pay taxes on loans. So you get this money to use. Now the money you make off of that $110,000, that's going to be based on
Your per current tax rate.
current rate, your marginal rate, whatever it
Whatever
is.
you want to call
Yeah,
it. Yeah.
then the next one up. So that's just kind of cool. Anything I can do and not pay taxes, I just shiver and get excited. But anyway, thank you, Bob. I appreciate it. Oh, one more thing while you're up here, Bob.
Okay.
You know, Bob comes to a lot of these meetings, and when we're up here and we're talking about things, we want you to know the tax implications. But legally, we're not supposed to say it, okay? So it's really convenient when you have a tax man in the audience to ask the questions for. And he can get up and say, he's not up here saying, you know, I was at a seminar and I was listening to Pete Fortunato. He's really good, and this is what I learned on taxes, okay? He can actually say, I'm a CPA, I do this for a living. As a matter of fact, I do taxes for a living, and this is the way the tax law works. That is a huge asset, probably underappreciated. But not only does he come here, He goes to Poplarville's REIA, and he's there for them. And he goes to Hattiesburg. So, Bob, hang on just a second. Let me see, Bob. Oh, here it is. This has got your name on it. This is an appreciation for everything you do for all of us. You can go ahead and open it up if you want. You're welcome, Bob.
Go ahead and open it.
Yeah, open it up. It's not nothing you don't already know, but it's kind of cool. Read it out loud.
Things turn out best for the people who make the best of the way things turn out. John Wooden.
All right, there you go. I'll keep the paper. Thank you so much, Bob. I appreciate it. All right, well, let's move on to the next one. And the next one. All right, this is walking the mortgage on steroids, okay? This is where we, you bought that hammer at Home Depot and, you hit your finger 5 or 6 times, but we're past that now. We're just whizzing it now. We're getting really good. All right, let's move on to the first slide. All right, there's a situation. Now, this is a fun story. This is for educational purposes. This is not for marital advice. And as mentioned before, it's not for legal or accounting advice. This is what you got. You got a beautiful home, $200,000, $125,000 worth of debt, but there's an ugly cloud, just like on top of Linus, over this house. And that is because, see that sad face right there? This is a bad loan, bad loan. It's either got high interest rate, it's got a short period of time, but this one is really, really bad. Y'all ever notice, you watch those things on TV, you get the little, the lion cubs, they're real cute and furry when they're little. When they grow up, they're capable of killing you. Yeah, that's kind of like this debt right here. I want to show you the problem with this. Cole, you can keep your seat. I'll do this on my own. I was going to get Cole to help me. Just in case this thing gets a little carried away, I got a little something for it. This ain't a Christmas present, but what's in this box here has been the ruin of many an investor, both young and old. All right. I might go off camera for this, but it'll be all right. Just be careful here. It's the dreaded balloon mortgage. It'll come up and bite you. You want to say time fly fast, sign a balloon mortgage. This particular one has got about 2 years left on it, and this acid is starting to eat into the husband and the wife, okay? And they're just so stretched thin, everything's thin. They went to every seminar they could, bought every property they could for no money down, never sold any of them to raise cash. And, they're strapped, and they got this balloon mortgage coming due. The market's changed. They can't go get the loans they used to could, and they're quite, frankly, they're a little worried. They thought they would just refinance this at the bank because they got plenty of equity, but like I say, the lending market's changed. Now, some people can borrow money. First-time home buyers can buy it. People that have a job in an industry that's probably going to close their doors in 6 months, they can get a job, but real estate investors aren't favored at this particular time. So, husband, what to do? What to do? He finds this house. Notice it's got a little work needs to be done to it. This is his solution right here. $125,000 value as is. This is his solution. He comes home and tells his wife, honey, I've solved our financial problem. She said, what are you going to do? Which one are you going to sell? No, I ain't selling. I'm buying this dilapidated fixer-upper over here. Well, this is what happens. She runs into her room, locks the door. Tears just flowing down her face. She picks up the phone. She calls her mama. Mama, you're not going to believe what my husband just did. And she just goes on and on. It takes about 45 minutes to get this all out. When they hang up, her mama picks up the phone, calls your mama. Your son, I can't believe, of all the things he's done, this is the craziest. And like I say, it's marital advice. You should discuss it beforehand. Your mama calls you. Son, What has gotten into you? You know, I mean, ever since you've been in this real estate business, and take another 45 minutes. So that's where we are. And wife ain't too happy. All right, but you signed the deal, so you got to go through with it. So let's go to the next deal. Next page. Let's see what happens. Okay, here's what's going to happen. The warranty deed is going to you on this as-is house. The note is going to you. This time you've gotten smarter. You've been in the business for a while, and you figured out, if I'm buying a house that needs a lot of repairs, I don't have to give them any money up front. I'll just start making payments. They're lucky to sell it. A little harder market you got today. But anyway, it makes it easy for the example too. So, there's no money changing. They're giving you a warranty deed. You're giving them the note. And you're giving them a mortgage that secures the note. Now this is where it gets fun. This time, the mortgage secures against this house and this house. See, the sale of this house, despite the fact you don't have any money, they're feeling really good because they got to get their house back, and hopefully you'll do some repairs before they get it back, and they get a shot at your house if you don't pay. So they're feeling good. They got what's called a happy, happy loan. They're happy if you pay, they're happy if you don't. So let's look at this a little bit, what happens here. This is why you get an attorney to do this, because sometimes it gets a little confusing. You got two releases here. You use one or the other. That's not exactly right. You could release them both if for some reason you paid the note completely off, then they would both be released, okay? But you got extra releases in here. Now the security on this one releases this house should this debt get paid down a dollar amount. An easy one to negotiate is $125,000 paid down. Because then they got a first mortgage at $125,000, $75,000 equity from a house that was a piece of garbage, okay? They're happy. What could go wrong? So you get this release if it's paid down here. If it gets paid down here, this one gets released. Now the other release is in the event things don't go the way you want. This is a good thing for you to learn, that phrase, in the event it don't go the way I want. You need to have a plan for that. Let's say you're not able to do what you want to with this house, but you're able to pay this mortgage down, say $25,000. At that point, their equity position has gone from 0 down to 100. You've done some repairs. At that point, you want them to release this property. Understand? They'll still have the mortgage on this one because you paid the note down. So they have the mortgage here, and you can do whatever you want to here. Maybe what happened was, in the real world, your tenant here came up to you and said, hey, you know, I really like to buy this house. I've been renting it and paying you on time, and we're fixing to buy a house. I'd like to buy this one. You said, would you really? 2-year balloon, remember? So you sell this to him. You get $75,000 and you pay 25 of it down on this note. So you want this one released so you can do it. They're feeling comfortable because they only got, what was it, 100,000 left, or whatever the dollar is. Any questions on that?
For those who don't know, could you explain a balloon mortgage just really quick?
Think of hell. Times 10. Now basically what it works is, we all know how mortgages start. They start here, the payments are steady, let's say 30 years, and then it's paid off. But the balance actually goes like this. It just goes down a little, then a lot towards the end, okay? A balloon mortgage is you start paying here, you don't get to the full 30 years, you get to wherever the balloon is, say 5 years, 7 years. And at that point, the note is due. Whatever the balance is, you have to pay it right then. Now everybody signs these thinking they're gonna refinance them, you know, just like those adjustable rate mortgages they signed in 2008. But when it comes time to actually get the money, sometimes it doesn't work out. That's why I don't like to sign them, okay? But A lot of people sign balloon mortgages and work. It's just what level of risk are you willing to take? You know, I'll never sign another one unless it's 10 years out. You know, and I'm going to sell it in 2. You know, but does everybody understand what a balloon mortgage is now? Okay, no confusion there. Okay, so you come home, you bring all the paperwork with you, you got the deed in your hand, and you got your copy of the note that you got to pay and your copy of the deed of trust you got to pay. And, well, you don't have the deed, you have a copy of it. Because John here at the title company kept all the original paperwork because he's going to go record it, okay? Because it's not really any good until John records it, you know. Well, it's some good, but it's not the best good. So you come home, and your wife, God bless her, she has gone through your closet, and there was a t-shirt you bought to kind of torment her with, old raggedy t-shirt. She's found it, and she's wearing it. Evelyn, can you come over here and read it for the audience? All right, let's face the camera. This is what the t-shirt says. What's it say?
Cool story, babe. Now go make me a sandwich.
She ain't too impressed. Things ain't very good. So, we're ready to move on. We're almost done. Let's go to the next one. Now, things go as planned, and we sold that house over there. And we paid off, okay, we sold that house, and that gave us the release. Go back one, just a second. Okay, all right. We sold this house right here for $125,000. And we took that $125,000 and we paid off this bad debt, okay? But the mortgage you signed to get this house is still secured against this house. It was here as a second, and now it's slipped down to a first. All right, turn the page. And this is what it looks like. That one's gone. The neon sign's got somebody else's name pointing down at the title of the house. You may have made some money at it if you did it right, okay? And you may have not made any money and just broke even if you did it right. When you got a balloon mortgage and you get out of it, you did it right, okay? The ones laughing have either signed a balloon mortgage or seen other people that have or heard the story. Okay, so you see the clouds gone. It's sunny, sunny, sunny. We still have our same house. We still got our $75,000, except this time we have good debt. The rate may have come down. The amortization schedule is definitely fixed. There's no more balloons. It's very, very happy. Everybody is just ecstatic. The threat of foreclosure is gone. You come home. Come back up here, Evelyn. The wife has a new t-shirt she went and bought. And you got to read this one like you really mean it.
Okay.
All right?
All right. Trophy husband.
There you go. Trophy husband. She gets on the phone. She calls her mama. Don't you ever doubt my man again, mama. My man's the best. Bye, 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 bye. He goes on for 45 minutes. Her mama calls your mama. You know, there's nothing in this world we love more than our daughter. It's the most precious thing. And we just want to thank you so much for the good job you did of raising your son to make such a great husband for her. Your mama calls you. Son, I'm so proud of you. I've always been proud of you. I've never doubted you, son. I knew that you know you would be successful. You know. All right. That's kind of humorous, but the people involved are here to bring a point, and this point is worth the whole evening, and it has nothing to do with finance. But this is the quote. Oop, 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 oop. This is definitely mama hat stuff right here. Got this from YouTube, so you know it's good. There will always be someone who doesn't believe in you. Always. Your job is to make sure that someone is not you. Okay? Sorry y'all didn't write it down, but I suggest you do. It's a good one. I'm going to say it one more time. There's always going to be someone that's not going to believe in you, and your job is to make sure that someone is not you. So that's it. Before we go into questions, I will answer right now the number one question I always get. Did I do the artwork? Absolutely not. I got a girl with she has a fine arts degree in graphic design. She did these for me. We may talk about her later. This is a little emotional right now. She ain't a lover, she's just a friend. So is her husband. Okay, I'll talk about it now. I can do it. You know, we talked a little bit earlier about getting filthy, stinking rich, but truly the things that are most valuable to you, you can't buy with money. Never can, never would. This woman, friend of mine, friend of my wife, when I had my cancer surgery, you know, a lot of people tell you they're going to pray for you. And I appreciate everyone because I do believe in the Bible where it says where two or more are gathered in righteousness that, you know, I will be there too. So I appreciate every prayer. But she and her husband didn't just pray for me. They actually fasted for me. Yeah. Brett's eyes got big because he's fasted before and it's not comfortable. I would have never asked her to do that, but she did it. And those kind of friendships, money can't buy. Your relationships with your family, and everybody's got different, you know, definition of family. A lot of them are different, but you know, money can't buy those relationships. So that's a very big part of Filthy Rich is the stuff that doesn't involve money. I just want to throw that out. Okay, so we'll ask more questions other than the artwork. Are there any other questions? You want to know who I am, how to get a hold of me? That's the phone number. You can call me. There is a warning, a caveat. You better text first and tell me who you are, otherwise, I'm not going to answer you. I get a gazillion telemarketing calls every day. I'm driving down here, listening to Pandora, and I get these telemarketing calls that knocks it off my iPhone because I'm old. I don't know how these iPhones work. And I got to push all these buttons to get it back on, you know. But seriously, if you don't text, you're not going to get a call back. But if you text, you tell me who you are, that we met at a REIA that I spoke at, I will call you back, okay? So any other questions, any confusion whatsoever? Sure.
What's a situation that you found is the most likely to be able to do this, to do the walk in mortgage?
I am so glad you asked that question. I really am, because I skipped something in the presentation. There's two kinds of walking the mortgage. There's the accidental that just kind of happens. You own this house, you like the mortgage, you're selling it, and you want to keep it. So you struggle to get them to take the mortgage on something else, okay? How many of y'all ever heard Leon talk? A lot of you, not all of you, but a lot of you. Leon told me a story one time. He was selling this land, and he bought it on a note with no due and sell clause, and then he sold it on wraparound, and the people were making payments, and then they paid him off. So he called up the guy that he was making payments to, and he says, "Hey, I got paid off, so I'm going to pay you off. Good news." I said, "Oh, wait, I'm them now. Oh, we don't want you to pay us off. We like getting that check in the mail every month because it's more interest than they could get at the bank." That was an easy one to walk, okay? That was an accidental one. The other kind is the premeditated one. That's where you do it ahead of time. And that's kind of what we did in that last example, you know, although we muddied it up on 2 different properties. The premeditated is the ones that I've done the most, you know. And, you know, I showed you where you can put it on 2 properties. You can buy this property here, and you can walk the mortgage at the very beginning over these 5 different properties if you wanted to, and they were willing to accept it. And you have releases in them, you know, 5 properties, $20,000 each, assuming that that's the way it worked out. And you just say, hey, look, I'll pay you $25,000 and you release this loan. So that way you can sell this one. I mean, if you're not making $25,000, why would you sell it, you know? So you pay off the note, you pay 4 of them off, and their $100,000 is paid off. The 5th one gets released simply because the note's paid, okay? That's the way I've done it the most, is when I did it up front, you know? But you're sitting down at the table, you're talking to the people, you know, like everything in the world is just one thing. You know, this mortgage, we need to put it over here, okay? Will every seller let you walk the mortgage? No. Will every seller accept every single offer you give them? No. You have to ask before you can get, okay?
Have you ever been in a situation where they're all right with no collateral? If you've walked the mortgage enough?
No.
Always on collateral?
No. Yeah. Now, some people have been, but I just haven't been that fortunate. Anything else?
Besides the seller financing, have you done any other mortgage to work mortgage between properties?
I'm sorry, in the seller financing,
No, besides, other than seller financing, do you have done other?
another way of work, I got a friend of mine that runs a bank. I mean, I say run it, he's one of the top guys in it. He says, for our good customers, whatever that means, we will, if they're paying us mortgage on this house and they're going to pay it off, we will walk it over to another house, okay? So with very minimal closing costs, they will do that because they hold the mortgage, all right? When you sign one with, you know, I don't even know the names anymore. I was going to say Wells Fargo, but they may keep their mortgages. Now, do they sell all of them? Do you know?
They pass them around. I mean, yeah.
Okay. So you make the loan with them. They sell it to somebody else. And you say, hey, look, I want you to take this property over here. They say, no. That ain't how it works. We need a new appraisal. We need new underwriting. It's a brand new loan. It ain't going to work. Gee, my heart, I'm getting heartburn right now thinking about that. Trying to make that conversation. It's just not going to work. But now when you go to your local community bank that keeps the paper in the office, and that's probably going to be a shorter loan. Maybe it's a 10-year loan. And you've been in it 3 years, and you say, hey, Sam, how's everything at the bank? It's good. Your bonuses coming in good? Yeah. When I pay off loans, that kind of reduces your book, doesn't it? Yeah. It don't really do you well, does it? No, not really. I mean, I'd have to make another one to make it up for you. Well, look, I got to pay this one off, but I'm going to make it easy for you. We're just going to move this mortgage. We'll keep the mortgage just like it is, and we're going to put it on this property over here. You might want to they'll want an appraisal. You know, we'll get an appraisal on the property, everything be squared away, and you'll keep your loan on the books, and you'll release this property over here. They will do that depending on how you paid them and what the current markets are, okay? If your old loan is at 4 and now it's at 6, they ain't gonna do it. If your old loan is at 6 and now the market's at 5, they're really happy to do it, okay? And if it's 6 and now it's 5, you may just want to get a new loan anyway. You know, you have to do the math to make it work. Any other questions? This has been long, guys. I hope it's been worth it to you. I got one more story. No, I got one other thing before the stories. Guys, I don't know if y'all realize it or not. I'm off camera, I know. These REIA meetings are hard to do, okay? It takes a lot of time calling people up to remind them to come, sending out emails, talking speakers to them and saying, you are going to show up, right? Yeah. Elbert, you were going to send me this PowerPoint presentation. We're getting kind of close to time, you know. Can you send it in with the bio? You know, you gotta follow up these people like children, okay? It's hard work, and he's done it to keep the doors open for you. He's not being paid for this, and I think he deserves a little recognition. So come on up here, I got something for you.
Thank you.
You're welcome.
Thank you. Open it here?
Yeah, open it here, man. It's just like Christmas.
All right. We do not do these things because they are easy, but because they are hard. JFK.
There you go. All right.
Thank you.
You're welcome.
Thank you.
You're more than welcome. And I got one more here. I forgot the number. I was going to ask you how many times I said make sure you walk the mortgage over at the beginning. And I think I got it to 5. I don't know if I went to 7. I think I stopped at 6. I usually do 7. So I can't ask that question. So, Brett, come up here, buddy. I got something for you. Old Brett does a lot of work at the Hattiesburg REIA and doesn't get a lot of credit for it. But we appreciate him there, okay? And I knew he was here. And he has come the furthest to support me at this talk, all the way from Hattiesburg. And I appreciate that. I really do. I do. And I got you some.
I appreciate it.
You're welcome. You know, nothing's for free. There's going to be a cost to this.
Right.
Okay.
I'll get the bill in the mail.
Now, you're going to pay up tonight.
It's only when you stop trying that you truly fail.
All right, stay up here a minute.
All right?
In the real estate business, if you do it long enough, you will fail at something. Maybe not totally fail out of the business, but you either didn't buy when you should or you bought when you shouldn't. You're going to make a mistake, all right? Failure, this is really good. Failure is not a tattoo. You don't have to wear it all of your life. Failure is a bruise. You can heal from it, okay? There's an old song back when I was young, which before most of y'all were born. It said, "Ooh, Jackie, ask them sometime, ask a winner, and you'll probably find they lost it sometime." So if you have a struggle, you do something wrong, and you cry and you whine, and that's all you do, you wasted the failure. But if you fail and you look at that failure and say, what went wrong? What can I do better next time? And you learn from it, then it's just tuition, you know? It's just tuition. You know, trust me, life does not teach you anything for free. If life teaches you something, you paid the price, all right? Brett, I really appreciate you. I really do. Now, here's what you got to do to pay for that. You've got to come up with a question about this presentation, and we'll see who can answer it first. And you've got to be the judge, because I ain't going to get nobody pissed off at me. You look and see who goes first, who answers it first.
All right.
I know he's on the spot. He didn't know this was coming.
No.
I mean, what's a good friend for, right?
Do you need some equity to walk the mortgage?
In most cases. Yes. All right, come on up here, buddy.
That was like the best question I could have got.
The only one you knew, right?
Yes,
Listen,
sir.
you're welcome. Listen, this thing's coming out on YouTube. I don't know when, but if any of you and any of y'all get confused, you can look at it in and go through it. I have a friend of mine. She's a special friend, but she has no special background. She wasn't a realtor. She wasn't a tax guy. She wasn't a legal guy. She didn't know anything about real estate, okay? And I gave this presentation, and she liked it, but she was a little bit confused. And she saw it a second time, and then I went to another REIA meeting, and she says, I showed it for Hattiesburg first, Poplarville second. I met her at Poplarville REIA later, and she said, Elbert, guess what? I walked the mortgage. Yep. So it's doable for everybody in here, all right? This isn't rocket scientist. everybody here can do it. And oh, you gotta open this thing up.
Oh, yeah.
Yeah, open it up. Show them what you got. This is old Zig Ziglar thing here, older than all of us.
Success is more attitude than it is aptitude.
There we go. All right. Thank you. Thank you very much. All right. You take care. All right. We're going to wrap it up real fast. I got one little quick story for you. Back when I was young, about that man's age, I was in college, and I was studying real estate and insurance. And in my mind, I figured that there's got to be a bunch of old men out there somewhere that are very good at this business. And they know about this business, but they're getting towards the end of their life. Their kids aren't interested in it. And the thing they want more than anything else, well, they shouldn't go that far, but one of the things they want a bunch is to be able to pass this knowledge on to somebody that will use it. It's my job to find these guys and get that knowledge. All right. Well, now I'm the 65-year-old guy, and I was absolutely right. I was right. The thing I enjoy most is to be able to take the knowledge that I've gotten, that I've paid for with blood, sweat, and tears and mistakes, and I've learned, and being able to pass this on to other people so that you can have a better life. Okay? So as much as, you know, this whole thing's been about you, this little bit's about me, okay? Y'all really have been a pleasure for me to talk to. You're engaged, you're paying attention, you're asking questions. You're not just waiting for it to end. So I really appreciate each and every one of you, I really do. Thank you very much. Now, hang on, I got two more things real quick for you.
All right.
Don't get too anxious. All right, what I want to do before we go, let's do that filthy thing, stinking rich thing. I just love that, okay? You ready? We all do it together. Okay, let's go.
Filthy, stinking, rich.
Okay, we're going to do it one more time. Got one more time here. Now, this time, I want y'all to stand up. And I want you to be so loud that they're going to call the police. We're about to go anyways. It'll be all right. And when we get through, I want you to give yourselves a hand for showing up here tonight. You could have done a lot of things, but you came out here to better your life. You've already clapped for me at the beginning. This is really why I wanted you to clap at the beginning, because now I want you to clap for yourself when we get through saying rich, okay? All right, this is the last time we're going to do this, and then I'll turn it over to Cole. Finally. All right, each and every one of us, we're going to take the tool that we learned today. We're going to take tools we learned yesterday, tools we learned in the future, and we're going to go into the marketplace, and not just the marketplace of real estate and finance, but the marketplace of life in every phase of our life, and we're going to do our dead level best to each and every one of us, different talents, but we're going to do our best to get
Filthy, stinking, rich.
all right. Thank you, Cole. Thank you, man. I appreciate it. Thank you very much.